There's a lot of polarization lately on YouTube between growth and value investing. Some growth investors are saying that value investing is dead and that Warren Buffett has lost his touch. And while this is highly entertaining to watch, I actually find it a little bit concerning. I'm conscious that new investors might get fooled into thinking that they can just ignore valuations, get over exuberant, and ignore the current economic times that we're in. As someone who invests for both growth and value, I think I can offer a balanced perspective, and I hope that this will make you better informed to make your investment decisions. I'm going to cover 3 things. Number 1, why it makes no sense to compare Berkshire's returns to any fund or index over the past 5 years. Number 2, why I don't think value investing is actually dead. And number 3, the lessons you can take from this as an investor going forward. So let's kick off with number 1. A YouTuber that I watch, that I know a lot of you watch as well, recently compared Berkshire's earnings to the earnings of a growth fund over the past 5 years, and then concluded that Warren had basically lost his touch. Now let me premise this by saying that I think the YouTuber in question is fantastic and he offers a load of value to his viewers, myself included. But I highly disagree with this comparison that he made, so I wanted to just explore it for a minute and explain my reasoning. So for starters, one is a publicly traded company with a market capitalization of nearly 500 billion. And first and foremost, this company is focused on capital preservation. The other is a growth fund with about 2 billion under management focused on growth and innovation. So you're trying to compare 2 completely different things that from the outset makes absolutely no sense. Secondly, the time horizon of the comparison makes for a very misleading story. Let me explain. You see, we could do the same thing if we compared Berkshire's returns to the S&P 500 over the past 5 years. Sure, Berkshire might have failed to outperform the S&P 500 over the past 5 years, but when you take a long-term view, you realise that that's a stupid comparison. It's like playing a 4-hour soccer match, and then with 5 minutes left and a score of 10-0, declaring that the last goal wins. Sure, the team with 0 goals might get the last goal, but that doesn't mean that they win the match. So if we look over the past 30 years, we can see that Buffett has outperformed the S&P 500 in all of the last 3 bear bull market cycles. If we just look at the 02 to 07 bull market, we see that Buffett returned just 79%, while the S&P 500 returned 108%. However, during the preceding bear market, known as the dot-com bubble, Berkshire gained 28%, while the S&P lost 45%. And it's the same story in the most recent bull market. Buffett gained 314% in comparison to the S&P's 389%. However, in the global financial crisis, Buffett only lost 41%, whereas the S&P lost 51%. So you can see the problem with only looking at the last bull market and conveniently forgetting about the bear market previous to that. Short-term outperformance during the bull market means nothing over the long term, and this is clear by the outperformance of Berkshire versus any index over the last 20-30 years. So saying that value investing is dead is equally as ridiculous. I mean, what is value investing really other than paying a price for something that's fair and limits risk? Sure, over-focusing on such things might limit performance during a bull market, but equally so, it keeps us protected during bear markets. And this should be clear to you now that this is the key to outperformance over the long term. As investors, we make a choice every day. We choose between defensiveness and offensiveness. In choosing defensiveness, we protect ourselves from losing money. And in choosing offensiveness, we protect ourselves from missing opportunity. Every investor can place themselves on a spectrum between defensiveness and offensiveness, depending on their lifestyle circumstance and their tolerance to risk. And it's clear which strategy has done better over the last 5 years. But don't be fooled into thinking that modern day value investing is dead. The price we pay for a business will always matter, and that is the essence of modern value investing. We are currently experiencing unprecedented activity in the level of stimulus being provided by the central bank and the level of economic disruption we are experiencing. Often we can look back at past events and make extrapolations as to what the future is going to look like based on them. But in this situation we can't even do that because we have nothing to draw from. So anybody that tells you that the future is knowable is clearly wrong. And because there's such uncertainty ahead of us, there's a real case to be made for moving forward but with caution. This is echoed by seasoned investors like Ray Dalio and Howard Marks. Businesses are still highly valued based on historical valuations, and this comes at a time of such uncertainty. Therefore, this should be factored into your investing decisions and your portfolio allocation strategy. Nobody really knows if we're going to have a V-shaped recovery or not. Fair enough, it's entertaining to watch, but that's as far as it goes. And even if the V-shaped recovery plays out, well, what happens after that? So what lessons can we take with us moving forward? So the first lesson I want you to take with you is that it's not about how much money you make in a bull market, but it's about how much you get to hold on to during a bear market. The combination of defensiveness and offensiveness is ultimately what determines our lifetime returns as investors. That's right, I said lifetime returns, not the last 5 years. Hopefully this means many bull and bear cycles. Secondly, move forward offensively if that's your strategy, but just be mentally prepared for the fact that your favourite growth company could lose 50% of its valuation. Make sure that you're investing in companies that you believe in for the long term, and that even if they drop in 50% of value, you have the liquidity and the stomach to keep averaging down on price. So many investors get complacent to the risks associated with investing, especially at a time like this when we had a big drop and then a bounce. People are getting irrational and they're forgetting the fact that the risk of another drop bigger than the last is still potentially there, and the next time we might not recover as quickly. And this advice is relevant for all investors in all situations, but I think it's particularly pertinent right now considering the economic environment we're in. Okay guys, so I hope this video brought you a bit of perspective and made you think about your current portfolio allocation strategy. If it brought you any value, then all I ask in return is that you give the video a like. Also, if you haven't yet subscribed to the channel, then consider doing so and hit the notification bell so that you get notified when I release future videos. As always, thanks so much for watching and have a lovely day.